You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Option Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. And the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out optionseducation.org. Now, here's your host, OIC's Director of Individual Investor Education, Joe Burgoyne.
We're taking your questions as always in today's industry happenings. Rick S. asks, what exactly does it mean to roll positions the week of expiration? Well, Rick, the term roll means to change or adjust your existing position. Those adjustments most likely would involve strike price and or time frame selection. So an existing position may roll up or down to a different strike or also roll out to a new time frame. And typically that's out as opposed to closer to expiration. The week of expiration is just the time an investor has chosen to make that roll. And you can actually roll a position at any time. Hope that covers it for you, Rick. Our second question comes from M.R. Bodine. He asks the following. What are the three main strategies used by option traders? Well, M.R., I'm going to assume you're referring to a retail option user when you suggest the three top strategies for an option trader. So I'm going to look at this from the retail option user perspective. My response is not based on quantitative findings, just my sense of things and what I hear from investors. Those three main strategies are the covered call or buy rate. That's an income producing strategy. Second would be selling cash secured puts, a strategy for either income or stock acquisition. And then finally, number three, I'd say is the protective put or married put position. This is a defensive strategy whose purpose is to protect a long underlying position with the purchase of a put. I'm pretty confident these are the main three option strategies used by investors. Actually, please go to our website at optionseducation.org to find out about all three strategies, the covered call or buy rate, selling the cash secured put, or the protective or married put. That's it for today's listener questions. Thanks for joining us on Industry Happenings.
It's time to break down the latest option strategies. That means it's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is friend Dave Whitmore of E Trade. Dave is a senior strategist of options education there. Welcome, Dave.
Hey, hi, Joe. Welcome. Thank you.
Hey, I'm welcoming you back to Wide World of Options. For those of you who may have missed you last time, how about if you offer just a brief description of your background in the industry before we get into today's topic?
Sure enough. Last time I think we talked about something a little more esoteric. I think it was a put-back spread, if I'm not mistaken. But, Joe, I've been in this business since, well, let's put it this way, since the online world. I've been in it since its dawn. It's over 25 years now. I was a broker. I was a manager. I've been a trader for a long time. And for the past decade at least, I've been doing trading education. My focus is pretty broad. Technical analysis, stock fundamentals, trading strategy, risk management, options, ETFs, the gamut. So we have a full program here at E Trade. We have a crew of subject matter experts like myself, and we do a whole program of education, from webinars to live events to trade shows, etc. So here I am ready to talk to you about, I don't know, maybe the most basic of strategies around, huh?
Let's do that. And I think what we're going to focus on is considering a long option position. So how about if you set the table for that discussion, maybe how or, where an investor should begin that process?
So, this is obviously the way that most new option traders step into the world of this idea of buying call options or put options as a position to benefit from a move in an underlying. And it's my sense that very often traders like that migrate to a single stock that they think they know, and they just put option strategies around that, and that usually consists of buying out of the money calls with short time period to expiration. And I'm suggesting that a better approach to this, once you sort of learn some of the nuances of time decay and leverage, that you start with the underlying. And first you do work to pick out underlying stocks that are going to be good options candidates instead of trying to fit option strategies to a particular symbol. So, that means doing some technical analysis work, figuring out the kind of setup that you think you're seeing in this chart, and I'm going to keep coming back to that. I think it requires chart work. Chart work is going to enable you to understand what might be a logical target price and how much time might be needed for that target price to be reached, and those are vital inputs when you get to the next step, which is figuring out what particular option and position you're going to put on. So, the first for me, Joe, is the underlying. You got to start with the underlying, and I think that's the soundest way to go about it.
Let me stop you there. I think we've got, our universe in the outlisted options world. It's a little over 4,400 underlyings, combination of individual companies, indexes, and ETFs. How does an investor go from 4,400 to 2, 3, 4, 5, or 6?
Well, you're right. The old needle in the haystack problem, I suppose. But so I'll start with the stock screen, and I'll just give you a sense of me. Over the weekend, a particular source of technical analysis research upgrades their latest findings on their stocks. Company's called Market Edge. It's available to E-Trade customers. I do a screen on Sunday or Monday for stocks that have been upgraded technically. I add a couple other layers in there. So for instance, I'm just looking for large cap stocks because I'm looking for those that are going to have option activity sufficient for me to trade. So I'm only looking for large company stocks. I put a couple other technical conditions, and I get a list of candidates of stocks that I think are good setups. Then I go through, and now they're not all going to be good setups. I got to look at the charts. I end up with a handful of stocks that I think are candidates. Then the next step is, and your point about all the listed options that are available, just having a stock candidate doesn't assure me that it's going to be a reasonable option candidate, because I have to find out if there's reasonable liquidity in the options for those. So now I got to turn to the option chains. And I scan through the option chains, and look, I'm looking through the volume in the open interest column, and if there's a bunch of zeros there, then that's not a candidate. So it's a simple process where I start with a general net that I put out regularly to get certain kinds of stocks that are participating at that time. And look, I'm going through looking for names that I know have liquidity, where I know there's going to be stocks that are going to have option liquidity. But that's the second step. You have to find liquidity. But now we haven't even gotten to the idea of choosing the strike and the expiration.
Right. Before we go there, let me ask you. And I'm a big believer. I think you're a proponent also. Don't establish too many positions, but two choices. You've got this scan that you're talking about that is, the whole universe. And then maybe you've got, a dozen companies that you follow, but maybe they don't have option liquidity. Which way would you fall in terms of initiating an option position?
So typically when I am, let's use the word nursing an option position, I am using I just have one or two existing positions at a time. I'm not managing a big options account. Look, I understand many option traders do that, and they have lots of positions, and they can be combined in different ways and create different requirements and different net positions. And when you add a leg, it changes the entire approach. I recognize that. What I'm talking about here is basically using options as a leveraged position to make a profit on a move in an underlying stock. And so for me, that week, I use my list that week, I might have two on. I might have two positions, a couple of 10 lots on a couple of different stocks that I think are making moves one way or the other.
Okay. All right. So considering a long options position, you mentioned the whole idea of strike and month.
Yeah.
Why don't we start that conversation?
Right. So now, assuming we've got a stock or two that are candidates, we determined that there's sufficient liquidity. Now we have to pick our strike and expiration. And the first point I want to make here is about theta. And for those that are new option traders, I'm simply talking about time decay. Time decay is a meaningful headwind for a long option holder. And one thing that you must appreciate is that an out-of-the-money option, and I'm not talking deep out of the money. Just consider three different options, one that's a little in the money, one that's at the money, and one that's a little out of the money. And if the stock moves in your direction right away, that out of the money will give you the biggest bang. However, the effect of time decay, as that option goes through its life, say 10 days go by and you're still holding the position and maybe the stock is near your target price, you might barely be at break even in that option by that time, whereas the in the monies will have intrinsic value to them and will hold more of their value. And so this trade-off between time and moneyness is a big one. And here are two rules of thumb that I've learned to use as guidelines. One, I don't want to hold an option for into the 25th or less day of its life. I want to avoid that rapid time decay that occurs in the last 30 days. And so my target is holding it to 25 days. So that means I have to do some chart work. Let's say I figure out that it could take 2 weeks for the stock to reach my target price. That's 14 days, call it 15. I need to add 25 to that, and that means that the minimum expiration I'm going to buy on that is 40 days. So that exercise is the first one, is I always want to plan to hold positions so that I can get out of them as a worst case before that last month accelerates. The second point is, go ahead.
Before you go there, that is an extraordinarily tight window, 2 weeks. What if people want to buy more time? Is that okay?
Yeah. Oh, look, if you're using weekly charts and your chart says it could take 3 months for the stock to get to this position, then I'm going to add an entire additional month to that and maybe even another 6 weeks. So in that case, I would buy, the month of time that I think the target is plus 6 weeks, say. So in that case, I'd be buying, what would that be, 10 weeks for a 3 or 4 week envisioned holding period.
Okay.
Basically, always cushioning myself so that I can be out of that before the rapid time decay occurs.
Okay,
always buying more time than the idea of saying, I think it can get there by this date, therefore I buy that expiration date, is the wrong way to approach it. You need to extend that expiration out. Call it 30 days more. I'll say 25. For thing. The second point about strike price is simply buy some intrinsic value. I know the out of the monies are tempting, but even if it's an at the money with just a little bit of an intrinsic value, spending more money on fewer contracts, on options with intrinsic value, gives them ballast in their price performance. They still provide you leverage on a correct move. You can make a multiple of your money on a correctly positioned long option, even if it's in the money. But I think you'll find over the long run that trading in the monies, at least with some intrinsic value, is a more attractive way to trade options than the boom or bust of the home run out of the monies with no time.
Okay, love it. Some great black and white rules there. That whole out by 25 days is very, I think very helpful for investors. As you go further out in time, and I know your focus in point number one was theta, as you buy extended time, that whole aspect of the volatility level comes into play, implied volatility. Is that right?
Volatility is always going to be a factor in these kinds of strategies. And in many cases, I think that the volatility factor is going to come from whatever chart setup you had. So let me give you a notion. If I've got a stock that has been falling hard or has been in a high volatility sideways chop and then is in the downward leg, I might have high implied volatilities in there. Or if a stock has been on a tear straight up, and maybe it's gone parabolic, I might see very high volatilities. If a stock has been in a calm uptrend and is simply pulling back to support area, which is one of the ways that sort of the stocks that I often try to look for, implied volatilities might be docile. And so that all that means is I'm going to get those options a little cheaper. If the stock's in sort of a gentle, organized pullback as opposed to being in some, significant chart swing. But the more, look, bottom line, and Joe, you just raised it, the longer the period you're talking about of a price target or a thesis for owning the stock, the more the changing volatility comes into play. But remember, the beauty of holding a very long-term option is the time decay is relatively zero, hardly any as a few days go by if you have a very long-term option. And so that's one of the benefits of owning longer ones. But that, I'm going to, as soon as you start arguing that you like this stock because you think its earnings are going to grow for the next, 3-4 quarters, I question whether an option strategy is the right one. I mean, in that situation, you should just own the stock, I think. But, I think options are more appealing for shorter-term moves where you achieve this leverage in a short period of time.
Okay. I won't get into that discussion about capital efficiencies with the leverage of an option. Maybe next time. But one last question for you. And, you spoke about, strongly considering the idea of buying that option with some intrinsic value. That obviously is going to be more expensive than the at or out of the money. Can you offer your insights to size of position?
Well, one of the rules of thumb in trading that we talk about in our education programs when we do risk management and trading strategy is position sizing that starts with the maximum amount of the loss that you'd be willing to take on any particular trade. So just look at yourself in a vacuum. You've got the initial deposit in a trading account, and let's say you put $100,000 into it, and you have a rule of thumb that says I'm not going to lose any more than, say, 2% per trade. So you start off by saying, okay, that's $2,000. Now, once you know your target price and your cost price, your risk-reward ratio, you can figure out how much of a trade represents a maximum loss of $2,000. Now, with long options, you have the beauty of simply saying, well, the most I'll do is pay $2,000. That would be assuming that you would be willing to let it go worthless, which I would urge our listeners to think in terms of still liquidating an option if it's got value, if the underlying hasn't gone in the right move, in the right direction. So you should do a sizing exercise like that. So let's go back to the numbers. You should probably have it be so that any one trade is a loss of no more than 2% of your portfolio. One thing that does is that decreases your position size. If you lose money, the next is 2%, say, of now a smaller number. So your position size goes down or rises as the portfolio size rises and falls. And then the 100,000 I talked about, that's not 100,000 of your net worth. That's 100,000 of what we would call your risk capital, or money that you are willing to put into a trading account with some aggressiveness behind it. So, Joe, that would be my beginning guidelines. There's a lot more literature on the math of risk management and money management, but there's a little nudge in the right direction.
Indeed it is, Dave. Can't thank you enough for coming back on the Wide World of Options. Always great to, get your wisdom. I know our audience appreciates it a great deal. So, again, folks, that's Dave Whitmore, Senior Strategist of Trader Education at E Trade. They have all kinds of both live events and digital offerings the year around. So be sure to check them out. David,
fantastic.
Thanks very much.
Thank you, Joe. Appreciate it very much. Thanks to all. Good day.
Now, let's meet the movers and shakers from the world of options in Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Alex Osinga. Alex is a marketing and events analyst at the OCC. Welcome, Alex.
Hello, Joe. Thank you for having me on today's show. I'm excited to be here.
Hey, it's a pleasure to have you. Always great to talk to a colleague and introduce colleagues to our listening audience. How about if you tell our audience a little bit about, what you've done before joining OCC?
Yeah, I'd be happy to. I studied at Madison and moved to Chicago after graduation, where I landed a marketing role at Clear Channel. I worked with many different national accounts across industries, essentially providing them with rationale as to why they should invest in our markets and audience. This is where I discovered my passion for and the importance of getting the right message to the right person at the right time. That's what is so exciting about digital marketing and the role of automation, which is something that we strive here to get right at the Options Industry Council, especially in our marketing efforts.
Indeed, you do. And really, I think there's nothing better than anybody, but especially, a young person, finding that passion, because then you got a laser focus and you love what you do. So good for you. We're lucky to have you as part of the team. How long have you been here at OCC?
Thanks, Joe. I've been here for 2 years as part of the Options Industry Council's team, helping provide education to investors about options. What really gravitated me to this role was the fact that we're here to educate even more. We offer all of our content free of charge in various types of formats. We're fully aware that we are in the digital age, and what's great to see from our leadership is the adaptations to the different learning platforms and our investors' learning needs. As we've increased our digital content library and launched an entirely new site designed to be customized to our investors, it's crucial that we stay ahead of the ever-changing digital landscape, especially in the digital learning space that we're in.
Well, it is challenging to stay ahead of that, as fast-moving as it is. But, you and the team with Leisha, Trish, Lindsay, we're all pushing to make this happen. You touched on a couple things there, and I know we want to get into the webinar program, but how about your day-to-day responsibilities at OIC? Tell us a little bit about that.
Yeah, like you mentioned, we have a great team here at OIC. In short, I manage the OIC's webinar program and support our digital marketing efforts. However, like I said, we're a small team, so there's opportunity to wear many hats and to work with many different teams. We definitely, lean on our web development team, our new business team, or corporate communications team. So it's a very collaborative work environment, all to produce really quality events for our investors.
And as you said, everything we offer is funded by the industry, so it's free. And if I may just kind of self-promote myself, I mean, free sometimes can mean, well, maybe it's not so hot, but we really produce first-class, educational material day in, day out, and I think that's why involving ourselves in the digital age is so important, because we get the opportunity to reach so many more people with the content that we're offering. So, all good, and you can't beat the price for sure. As we referenced the webinar program a little bit. Why don't you, get into some of the details of that offering?
Yeah, I'd be happy to. The OIC webinar program began before I started in 2014, I believe. With the goal of just increasing our digital outreach and improving upon our digital content library. We've grown the webinar program into one of OIC's most engaging and successful digital offerings, where we reach over 1,000 investors every month, with the goal of reaching a new audience. It's exciting to see the program's growth over the past year and a half, and I'm excited to see where we can go together with the program. One of the and I'm jumping ahead, but one of the best things about our program is how happy we are to engage with our audience, and that's something that we're always in tune with in terms of producing quality events for our investors.
So give me a little insight into that. So we're talking digital. Somebody can be sitting who knows where, and they tune into us at 3:30 Central Time. How do you engage with that person who may be sitting at their work desk or in their bedroom? How do you engage with them?
We engage. That's a good question, Joe. Especially we're taking our learning and education outside of the classroom into a virtual and digital environment. There's a sense that we might be we want to make sure that we connect with our audience and make sure that they have a lasting impression on our program. And one of our goals is obviously to give the best experience to our audience as possible. If someone's having any issues or have any questions, I'm here to help them, to point them in the right direction. It's something that I enjoy, and I know our team at OIC feels the same way. Our investor services team is incredibly knowledgeable and always there to help investors with whatever options-related questions they might have. And I think this is a main driver to why people enjoy our program and keep coming back.
Our colleagues at Investor Services, as you mentioned, do a great job. How can investors who engage in our digital program reach Ed, Bill, or Mark at Investor Services?
Great question. If investors can reach our Investor Services team at options@theocc.com. That's options with an S at theocc.com. And they're attentive with their email, and they'll respond to you within 24 hours with a response.
Fantastic. Don't want to put words in your mouth, but it does sound like you enjoy that interaction, with the audience. Is that true?
Absolutely. I love it. It's one of the greatest things that, OIC has to offer is that connection with the audience. It's a one-to-one connection that we strive to attain across all of our platforms. We are, always there to answer, questions that investors might have, just to help build their confidence, so that they can, begin investing in options or further their investing experience with options.
Fantastic. Along those lines, you want to offer your cell number so people can reach you 24/7?
Maybe not my cell phone, but I'll give you. Might be able to give you my work number.
Back to the whole aspect of live events. I mean, I'm lucky enough to participate in a number of them myself. You never know when, there's going to be a hiccup. Do you have a fun live event hiccup story you'd like to offer?
Yeah, there's always room for a little bit of improv whenever it comes down to a live event, which keeps things interesting. One time, I recall we were putting together a webinar, and Mark Benzequin, who's part of the investor services team here at OIC, he was finishing up his presentation, and towards the end of his event or his webinar, his audio or his phone line cut out. And
that's a problem.
We strive to, yeah, indeed. And we strive to make sure that the experience is as seamless as possible. So as soon as Mark dropped off, I communicated to the audience, what the issue was, so that they aren't lost in the dead air. And I communicated to Mark that, hey, if he comes to come to my desk, and we'll finish up the webinar, and we'll be able to close the show. And so we ended up taking the rest of the webinar at my desk, and just closing out the conversation with the audience, and to make sure that they didn't feel lost, because at the end of the day they don't see what's happening in terms of any problems or issues, and it's our job to make sure that those issues don't make it to the audience, and if those issues do, then we communicate it to them, and we will do the best of our ability to get the rest of the webinar complete.
Well, it sounds like you handled that hot potato well. If I had been Mark in that situation, I'd be 800 miles away, so might have been a little more challenging. But yeah, that's the beauty of live events. You never quite know. It does keep you on your toes. As we wrap up, Alex, how about your perspective on what you think is OIC, OCC, the clearinghouse, or do you think we're making a difference, for the industry?
Oh, absolutely, Joe. I think one of our mission is to educate investors about the benefits and risks of exchange-listed equity options. And I think we accomplished this by providing independent, unbiased education and practical knowledge to individual investors, financial advisors, and institutional managers across a range of media, with a heavy focus on our digital initiatives, obviously including the OIC webinar program. And I think with Mary Savoy's leadership, we have taken the right strides to remain relevant and top of mind for our investors and industry partners. I mean, we just celebrated our 25th anniversary, which we're very proud of. I mean, it's incredible to say we have been helping investors for a quarter of a century, and we will continue to help investors through our educational resources. This is what we're all about, and it's great. It's great to be part of the that whole initiative and the whole momentum to educate investors about options.
Amen to that, Alex. It really is a privilege to be part of this team, and it's good to hear from you. Glad we had an opportunity to introduce you to our listening audience. So, again, folks, it's Alex Osinga, Marketing and Events Analyst at the OCC. Alex, thanks so much for joining us today.
Absolutely. Thank you, Joe. And if you don't mind, I'd like to plug in our webinars. Will be wrapping up this year on Thursdays at 3:30 p.m. Central Time. So look onto our website. Keep an eye out for our events. They'll be typically the second and third Thursdays of each month at 3:30 p.m.
That's great, Alex. And of course, you can find that at optionseducation.org. Alex, thanks again.
Awesome. Thanks, Joe.
Next, let's upgrade your options toolbox with cutting-edge trading platforms, devices, and information. Let's talk about tools, resources, and good reads.
We'll start off today's tools, resources, and good reads with two offerings I've mentioned before, but we're always adding new listeners. So here goes. Our tool for you to consider is iVolatility.com's website. There are lots of tools, many of them free. Do check it out. That's iVolatility.com. Our resource, and for our regular listeners, this is one of my very favorites. Please check out the volatility charts on our very own website at optionseducation.org. For those of you who don't know, vol charts, are a key aspect to analyzing any options position, and you really shouldn't be overwhelmed by adding the whole idea of volatility charts into your homework prior to initiating any options position. Remember, what vol charts offer are relative levels of premium in all your option contracts. By just looking at the chart, you'll get a relative level whether option premiums are high, low, or at a midpoint over the past 12 months. For me, that's incredibly important information to know before I initiate any option position. That's it for today's tools, resources, and good reads.
Ready for a little nostalgia? It's time to take a look back.
In today's Looking Back, I'd like to offer a very brief update on the option exchange consolidation over the past few years. We're now at 5 parent companies and counting, down from a high of 7 a couple of years ago. Most recently, the CBOE purchased BATS. BATS added their options business to CBOE offerings, as well as extensive equity operations across the globe. Now, the other major change in option exchange hierarchy was the NASDAQ purchase of ISE from Murex Group a couple years ago. As you may know, the ISE, founded in 1999, was the first electronics options exchange and really opened the doors to efficient option execution back in the day. So that's the latest on industry consolidation, and that's today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email Joe Burgoyne at options@theocc.com or visit optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at optionseducation, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.